The debate over retail investors trading in derivatives is heating up. From mandatory exams and increased margin requirements to stringent net worth evaluations, the debate has now pivoted to a potential 30% tax on derivatives transaction similar to taxation on cryptocurrency. These rules are meant to stop people from taking big risks and protect investors, but what they have actually done is ignite fierce debate about their actual effectiveness and the ripple effect they could unleash on market behavior. Before delving into whether a 30% measure will be effective, it's important to understand how the futures and options market functions. Futures and options are financial contracts used in trading. A future is an agreement to buy or sell an asset at a predetermined price on a specific future date. Options, on the other hand, provides a right but not the obligation to buy or sell an asset at a set price before a certain date. For example, if you think a stock's price will rise, you might buy a call option to lock in today's price for future purchases. Now, traders use F&O to speculate for profits or to hedge against potential losses, making these tools versatile in managing investment risks. But is it really speculation though? If you think an event will impact a stock's price, you need the know-how to understand whether the price will actually go up or down. So trading futures and options is about skill, not just luck. Consider this. Suppose you closely follow the technology sector and anticipate the company's earnings report will exceed market expectations, likely boosting the stock price. With this insight, you strategically buy call options on the company's stock. This decision leverages on your expertise in interpreting financial reports and market trends. Now, if your prediction proves correct and the stock price indeed rises, your call options could yield substantial profits. In this way, F&O trading combines market knowledge, analysis, and strategic decision making, and it's a game of skill where informed predictions can lead to profitable outcomes rather than relying solely on chance. Another reason why people trade in F&O is to hedge their positions. Hedging is a strategy to protect investment from market risk. In future and options, one can hedge a cash position by buying option contract to offset potential losses. For example, imagine you own stocks worth Rs 10,000 and are concerned about a market downturn. By purchasing put options, you secure the right to sell your stock at a specified price even if the market value drops. This strategy allows you to mitigate potential losses while still benefiting from any upward movement in the market. Essentially, hedging in F&O acts like insurance, safeguarding your investments from unforeseen market movements. As you can see, hedging is different from speculation as it focuses on minimizing downside risk rather than profiting from market fluctuations. It safeguards investors and their investments against adverse events, making it a prudent approach. Now, restrictions on hedging could intensify market volatility by exposing these investors to greater uncertainty and risk. Imposing a 30% tax on F&O would discourage hedging because distinguishing between speculation and hedging is practically impossible. Such a tax would likely deter investors from protecting their positions effectively, potentially leading to increased market volatility and more losses for the small guys. And even if we logically can write off these arguments and say that the 30% tax will restrict people from dabbling in derivatives, answer this. How many people actually make money in F&O? As per SEBI's own admission, 9 out of 10 traders incur losses in futures and options. So the majority of traders in F&O are already experiencing losses. A 30% tax on F&O trade may indeed not deter new entrants or significantly reduce overall market participation. This is because those who are already losing money might not be dissuaded from trading because of the tax itself, since losses are not taxed. Therefore, the effectiveness of such a tax in curbing speculative activity or reducing market participation might be limited. Instead, regulatory measures should focus on education, risk management, and transparency, as it could potentially benefit traders more effectively in the long run.